Hey everybody, so leave a comment so I know you're here. I'll do a couple of Amazon gift card giveaways, and it's legit. You can ask the people that won. They do get the Amazon gift card. It's not just saying that. And if you want to make it easier, you have to comment though, so I know you're here, so I can put you on the list. But if you do want to make it easier, email me now or anytime, but definitely email me if you win at financial.business.consultant.sr at Gmail. And just say, this is my email and my YouTube handle is this. So I have your email already. Because the way people can scam me is that say your YouTube name is like Jimmy123. Then they could just create a Gmail account, like calling it Jimmy something, and then just email me and say, hey, I won your raffle, send me the $20 Amazon gift card. And I send it to their email thinking they won, but it's actually you. So anyways, yeah, anytime, just leave a comment, say anything so I could just add you to the list. So I was looking at, let me show you the list I put together. I did a screener in E-Trade, and I looked for every small cap stock. I think if you're not sure, the definition of small cap, well, there's large cap, mid cap, and small cap. And I think there's even micro cap. I wrote in my phone, but I think small is 2 to 10. No. Let me look at my phone. I'm going to forget. Necro, what's up? Okay. It's good to know this stuff because, but anyway, so 50 to 300 million. Small cap is 300 million to 2 billion. Oh my God. Mid cap or medium cap. It says medium cap on my phone, 2 to 10 billion. And then large cap is 10 to 200 billion. I think those are the traditional groupings. There's also something called mega cap. I don't know if that's official, but that's over 200 billion. So anyways, so I did a screener on E-Trade. I have an E-Trade account. I've been using it for over 20 years. And I looked at every small cap, so 300 million to 2 billion. That's market cap. That trades between $1 and $5. The Wegro network, what's up? The Wegro network. Do you have a YouTube channel, the Wegro network? That sounds like a name of somebody that would have a channel. So yeah, I searched if you have between if the one share is between $1 and $5. So I started like populating the list. I just wanted to add 4 columns: the IPO year, the IPO price, the maximum price in its history, and a minimum price. And if it did a reverse stock split, I removed it from the list. If they did at least one reverse stock split, Wow, Eddie. That's really nice. That's really generous. Thank you so much. That's more. I think that might be the biggest donation ever. Although somebody I think might have did 100 once, but thank you. That's so nice. Small one. Where grows name my business? Everybody say thanks to Eddie. You know, it's like these types of things motivate me to do videos. Even even if it was a $1 donation, or even even a nice comment. I mean, it motivates me to do videos. So my friend told me about this strategy. Bulldog, what's up? Everybody sub to Bulldog. He does 24/7 live streams. Awesome guy. He's a great guy, Bulldog. So my idea is, if the stock has lots of ups and downs, like you see it going from like 2 to 10 over, like, say, a 1 month period or something like that, then it goes back down to $1, then it goes up to 20. Then if you see these spikes, then try to time it. When it hits the bottom spike, then there's a big run up, and obviously you got to get out before you lose all your money. So I'm just gonna try this strategy. I'm a long-term trader, buy and hold. Literally, my retirement stocks are probably going to be there till I retire or till I turn 60 or 70. So I'm going to hold for decades. But it's fun to gamble. It's fun to try to see if I can figure out a way to make money on these short-term movements. You don't want to put your rent money in there. If you could only afford $100, then do it. I'm dropping like $1 or $2 grand on these swing trades, but we have all of our price. We have our comfort level. When I get more comfortable, I might start putting 10 or 20 grand into these short trades if I see any success. But it is gambling, but you could make it smart gambling. It's kind of like if you go to the casino and you play slots. That's probably not smart gambling. You're probably not gonna, in the long run, win on slots. But if you start playing blackjack, now your odds are in your favor relative to slots. The odds are not in your favor in any casino game, really, versus the casino. You're always going to be against casino, but you have a better chance of winning money in blackjack. So try to play it smart. And then I literally just got bored after filling in a bunch of names, like going on this price chart and trying to fill out my spreadsheet. I started getting bored, so I wanted to look. I don't know how I came up with Agile Therapeutics. Oh yeah, I did another screener in E-Trade, and I screened. I can't remember what the screener was. Oh, okay. This is a screener. I was looking for small cap stocks that had 5 straight quarters of revenue growth that were trading at their 52-week lows. That's what I did. And this was the only stock that seemed to have. I think that it had a positive. What was it? It had some cash flow. It was the only stock that came up that had like positive cash flow, or at least some revenue. The others were like, because my screener was like 5 straight quarters of growing revenue, but some of the companies were like one quarter was like $1,000 of revenue. The next quarter was like 1,800 revenue. The next quarter was like 10,000. It was just like such small amounts of revenue. It just seemed ridiculous. But this company actually had, it seemed, and I know if you invest in this stock, you've lost everything almost, because it's done terrible. But I'll show you, they've actually had like real numbers. Like they went from, $750,000, so 2020. Because when you look at a biotech company, you have to expect pretty much no revenue for many, many years until you get a drug or something that gets FDA approved. So they really had no revenue prior to 2020. $750,000 in 2020, 4 million, 11 million, and then the trailing 12 months, 20 million. I'm like, wow, 20 million revenue, and their market cap is 5 million. I'm like, that's pretty interesting. That's like a 0.25 price to sales ratio. That's a really, really attractive price sales ratio. But then when you look at the chart, and let me know if you want me to do like a DCF. I could do a fast DCF. Leave a comment. Make sure you let me know you're here, so when I do the raffle. But when I was looking at the price chart, I see why no one wants to buy the stock anymore. Because they did a 1-for-40 reverse stock split, and that's a 2022. Then a 1-for-50 in 2023. So if you bought 2,000 shares before this first stock split, you'd have 1 share today at $2. So if you drop 20K into this company, 25,000 into this company in 2015, you'd have $2. So but it takes a long time to get. They weren't even generating any revenue until 2020. Yeah, pets. It's one of the rare times I invest in. I knew pets was a risky one. Abcelero is a risky one. I mean, I'm up 100% on another risky one. So on Nubank, which Nubank doesn't fit into my kind of like investing style, but I did put like 30,000 into it, and I think I'm at 60,000. I'm up 100%. So that worked out. But yeah, pets is a tough one, and I don't know. I don't think it's a good investment. I mean, it's a risky investment. It's not a slam dunk investment. I mean, they almost hit 50, right? And my cost basis, let me just see. I write it down. Every stock I own, I always write down when I bought it, my cost basis. So it's $12.78, and that was August. So that was, you can't even see it in this chart. Let me do 5 year. So August 2023. So it's pretty recently. I got it for $12.78. So it was already trading way higher than $12.78. So I think it will get back up to the 20s. I don't think it'll 50s. They would really need a pretty good amount of revenue, and a lot has to happen. But I think it's a great acquisition target. That's what that's one of the things I've been trying to do, and it's really hard. I've done it a few times. I identified an acquisition target, and they have been acquired, but I didn't invest in them, so it doesn't really tell you much. But any company, any small cap company, like under $1 billion, that generates positive cash flow, I think is an acquisition target. Because if you're like a $10 billion company or $50 billion company, whatever your size is, and you acquire them, you already have positive cash flow. So it's a lot less risk than acquiring one of these crappy companies that don't ever make money. Pets. I didn't know Pets did a reverse stock split. Yeah, I don't. They didn't do. Did you say? Didn't this reverse stock split too? No, I don't think they did. Unless I No, they've never done a stock split. The dividends look really good. They pay a dividend. It's like a really big yield. I think they said they're going to cut their dividend. It's like a 15% yield now. But they consistently paid a dividend for 12 years. Thank you, R. Aldridge. This is the most generous stream ever. Thank you. That's really nice. Cyan Ken. Leave a comment. It doesn't matter. Just say anything. So I can put you in a raffle. Because generally, if a company gets acquired, the target company, let's just say, who's a big PetSmart? Is it Pets? Who's a big? So let's just say PetSmart bought. Are they a public company, PetSmart? They're private. No. Let's just pretend Walmart acquired them. Walmart's in the same industry. So Walmart. No, not Walmart. What am I saying? Walgreens, I meant. Walgreens, so $23 billion company. Say they acquired PetMed Express. Generally, the target company, like PetMed Express, would go up. On average, the price of the stock increases like 50%. So Walgreens would announce, what the fuck happened? Walgreens would announce they're acquiring PetMed Express for $10 per share. So right away, so it's currently at $7.50, and they announced $10, which is $2.50 above where they're trading at. So the stock would go up 33% right away. It might not go up to $10 because there is a chance these things don't fall through. So it'll go to like $9.75 or something, $9.80. Premium Collector, what's up? Premium Collector. So yeah, so the target company goes up right away, pretty close, a little less than the price. Usually it's a little less than the price the acquiring company offers. And then like Walgreens would go down. Generally, the acquiring company goes down in price because in order to acquire a Petco or PetMed Express, Walgreens. I'm gonna write it down. I keep saying the wrong names. They need to they need to either use cash to acquire them, or they may need to dilute the shareholders, add more shares, or they may need to take on debt. So the stock price goes down because they have to pay for the acquisition. In the long run, the idea of any acquisition is, in the long run, it'll make the company better. So hopefully in the long run, Walgreens stock goes up. But initially, Walgreens stock would go down. But of course, market dynamics play in. So if Walgreens stock should have went down like 2%, say that was roughly the amount of like cash that left the company. Say they a few $100 million, it was 2% of the value. Market dynamics might play in, and people might just buy the stock because they just have high hopes, and it could actually go up 5%. Walgreens, I mean, it would have went up 7%, but that 2% cash detraction from the sale, or it could go down 5-6% Walgreens if the market doesn't like that acquisition. So no, I mean, it's really hard to, and that's generally the dynamics of an acquisition. But yeah, I like the business model of PetMed Express. I like animals, pets. It's like family. People will spend money on their pets. Same like with their kids. And I like the business model where they're not focused as much on a brick and mortar location. It's prescriptions and I think they sell other things too, not just prescriptions, like dog food or toys, things like that. And it's online. So I just like the business model. So that's what you got to look at too. It's not so much about price movements and so much about financials. Part of it is just if the business makes sense. Sometimes these companies start trading and the business model is like, it doesn't make sense. But the stock, that doesn't mean the stock may go up at 10,000% just because it's a meme stock. But if you look at what the business does, you're like, who would, they have such a small population of people that are interested in what they're selling. Or you don't have to have a huge moat. And someone talked about this last time. Ed, what's up? Somebody mentioned why can't just like any company like Amazon or Apple take over, do what Netflix does? They don't really have a moat because anybody can just start offering a streaming service. But I mean, anybody can do anything. I mean, there's no business out there that nobody can do. Only this company can do. You'll never find a business. Anybody can do anything. And the more money a company has, like the companies that have a ton of money, like Microsoft and Apple, they have like what, 300 billion of cash on a balance sheet. Like, so they can do anything. But it's just like certain businesses do have a higher barrier to entry. And the barrier is generally the cost. So it's a pretty high barrier to operate a streaming service. It's not like, I would say to operate a grocery store is a much lower barrier. You just need $500,000 to buy a space and to buy product. To operate a laundromat is a much lower barrier. You need much less money to open a laundromat, for instance. But you need an awful lot of money to become an aircraft manufacturer. You can't just do that with $100,000. You need like 100 million, because even to build one airplane, it would cost an enormous amount of money, and to scale that. So when you think of a moat, think of the money is a moat. It deters people, and also brand. So that's why Coca-Cola has such a moat, because of the brand. It's not that expensive to make cola. You could probably do it with $100. You buy seltzer and you could find a flavoring out there. But to do it where people actually would buy it from you, it doesn't matter if it tastes even better than Coca-Cola. They have such a brand name, so that's the moat, the brand name. And it would cost a decent amount to scale, to sell on scale too. There has been a catalyst, a synergy to the business. YouTube Bulldog. So the way it works is you have to get picked twice to win a raffle, and the number has to change. So, okay. So 9. So 9 gets picked once, Tommy Boy. And if he gets picked again, then he wins. So it has to change. That's the only thing. It can't stay in the same number. 5. R. Aldridge. Okay, it didn't change. No, that's so weird. Okay, so Tommy Boy, make sure you email me. Congratulations. Make sure you email me, and then I'll email you a $20 Amazon gift card. And don't try to scam me, because I have a way to confirm who it is. I'm not going to tell you how I do it, but there is a way for me to figure it out. But I used to have a channel where I scratch off lotto tickets, like scratch offs, and I would do a lot of like raffles, like thousands of dollars of giveaways because of if we won on the tickets. So there was a lot of scammers on that channel. Yeah. And that's my email, that financial.business.consultant. So this company, AGRX, I know if you own this stock in the past, you probably hate the company, and you would never invest a penny in them. And I don't blame you. And I did look. The executives get paid a lot of money. For a company that's not making any money, let me show you AGRX. That was a little concerning. So that's a little, that would hold me back from investing, is the amount of money. A company that has zero, of course they have to get paid. You can't like expect people to work for free. But I mean, the CEO gets $800,000. That's their base, their annual salary. Then $540,000, another $800,000 salary, and then a $550,000 salary. So it seems a little ridiculous, because they really need that money to run the business. I mean, I think a $200,000 salary is appropriate. Maybe 300. But if they were profitable, I could handle these salaries. But it's a little much. But anyways, so obviously they didn't get any revenue until 2020, because they were still developing their product. And they finally developed their first product, and now it's commercialized. Now they have sales, and they expect sales to continue growing. It's a patch. Twirler. So it's birth control. So women can put a patch on if they want to avoid getting pregnant. And the benefit of the patch. I just was reading what women said about Twirler on the reviews. They were saying that I like it because I don't forget to take it, because the pill, they say, some people mentioned sometimes they forget to take it every day. Even though it seems easy to do, it's easy to forget. But the patch, you just put it on, and then I don't know how, I think it lasts a couple of weeks. I don't know exactly. And sales are growing. There are side effects, but it's any drug or anything you put into your body, there's going to be side effects. But based on the reviews I read, not many negative comments in regards to side effects. So it's really hard to get up when you're in a medical field to get something FDA approved. That's kind of like the goal of these companies to get a product approved, and they did do that. And the stock is down dramatically because I guess people buy these kind of companies before they have any revenue in the hopes they get something FDA approved. And then when they do get something FDA approved, if the sales aren't as strong as they hoped, then people get upset. But it's not that the sales are bad, though. It's just that the stock keeps going down, because sometimes companies like a Tesla, before they were even had that much revenue, people buying the stock up like crazy. So just these kind of companies just fly below the radar, and they're not as popular as some of these big names. And the stock keeps going down, and unfortunately, they need to do a reverse stock split, because if a stock falls below $1, the company may get delisted, which means that they do not trade on a major stock exchange like the NASDAQ, New York Stock Exchange, or there's the TSX in Canada, that's a major exchange, or the London Stock Exchange. Those are major exchanges. And if you don't trade on a major exchange, it doesn't mean the company goes away. It just means there's less kind of activity on the pink sheets over the counter. People can still buy the stock the same way they could have before, but there's just less buyers and sellers, and you're probably never going to get much activity. Because really the only reason companies go public is access to capital, to the capital markets. That's the only reason, because they can get a nice cash flow, the inflow of cash. Because when they go public, they're selling the company essentially, and people buy shares in the company. But just the IPO, they benefit from. When it trades in the open market after the IPO, the company doesn't benefit at all, even if the stock goes to the moon. They only get the money out of IPO. They could, however, dilute shareholders and issue more shares. So if a stock goes up a ton after IPO, the company can benefit if they issue stock, because now they can issue stock at a higher price. So they dilute less. Because if they needed $1 million, right, and each share was $1, they would have to now issue 1 million shares. So let's just say, for instance, let me finish. Let's just say, for example, a company had 9 million shares outstanding, and they needed $1 million. Say they wanted to acquire another company, or they just needed money to run their day-to-day business. So So they need 1 million. Each share was trading at a $1 at that point, so they have to issue 1 million shares. So now the company has 10 million shares outstanding. So let's just say, for instance, you had 1,000 shares. I gotta. Oh boy. Let's make it a little more so it makes. Say you had 10,000 shares. You drop 10K into this company. So you own 0.1% of the entire company. You own 10,000 over 9 million. But once they do this, once they add 1 million shares, now you go from 0.11% to 0.1%, which sucks, right? You don't want to own less of the company, because if they do eventually pay a dividend, you're not going to get as much as you would have. But what if the stock price they shot way up from $1 to $50? Now they only have to issue 20,000 shares to get that $1 million they need. So your dilution you don't really get diluted nearly as much as before. You still own 10,000 shares in both scenarios, but now you own a little less of the company than you did because they added 20,000 shares. So here's a tricky one. There's really two benefits of a stock price going up for the company, for that corporate entity. There's two real benefits. This is obviously one benefit, because now they could issue shares without as much dilution as when the stock price goes up. Does anybody know the other benefit of a higher stock price for a company? It is a bit tricky, the other one. I know I mentioned it before. Does anybody know? Now, what do you mean by share offerings? Because remember, if a company's share price, like when GameStop's share price went up like 30,000%, GameStop did not sell more products because its share price went up. If a stock price goes way up or way down, it doesn't mean a company is going to sell that many more items. Share price is kind of separate. And a company can't go out of business from people shorting the stock. They can only go out of business is if the traditional way, they can't pay their debt holders. They don't have enough money from running their business. The company could really only sell shares at the current price. You can't really sell it for much less or much more. You know what? If you do an at the market offering, the company's selling shares at the current market price. So they just issue the shares. They sell the stock the same as you would sell your stock, whatever the current price is at the market. They could do a tender offer, which is a lot safer to do a tender offer than at the market. Well, not come on. So they can do a tender offer where they just say, on this date, say Alphabet says on February 1st, 2024. I don't even know how much Alphabet's trading at right now. 143. So they can do a tender offer saying on February 4th, we're gonna buy $1 billion of our own stock. Oh no, we're gonna issue new shares at like 150. And then you can sign up. And you could sign up to be part of the tender offer. Because if a company needs to issue say a lot of stock, say a company wants to sell 1 million more shares, if they need more money, if they do it like all at once, it might like crash the stock price. So they might do in stages, like $100,000 every other week, or they may do a tender offer. Because you got to be careful. You can't really issue all at once, because if you don't want to kill all your investors already. No, I mean the other big benefit of a stock price going up is that the convertible debt converts. Convertible debt converts to equity. So if you have a lot of convertible debt on your balance sheet, that means people gave you money, and you owe them. So you're indebted to them. Say it was Alphabet. So I gave Alphabet, say last month, $150 to buy a share of their stock, and say it expires on 2/1/24. So every convertible security is $150. So I gave them $150, and Alphabet will give me my $150 back on February 1st, 2024, unless I want to take a share of stock. Obviously today I won't, because it's 143. Why would I want to share for 143 when I gave them 150? And I know on February 1st they will give me my full 150 back. But if Alphabet stock goes up to 170, as long as it's any time before February 1st, then I'll just take one share of stock and give them my debt note back and say, here it is. You don't owe me any more money. Just give me a share, because I'm already locked in at 150. So that does help the company, because it removes a lot of debt off their balance sheet. As companies that have a lot of debt, especially small companies that are trying to grow, that's a big benefit. Of course, it does dilute shareholders, but it strengthens the balance sheet. 207, thanks for joining or rejoining. Premium collector. Oh, that's already on there. 207. If Fed doesn't cut rates as expected in first quarter, what stock sectors? If they don't cut rates, well, generally stocks do. I mean, it seems like the market goes up when rates are low, right? Fed does not cut rates as expected. What stock sectors is going to be down? I don't know. I think that's good for the market. What's going to be down? Anybody have any idea what's going to be down? I don't. Kyle, what's up? I think that's going to benefit the market because most companies have debt, fixed rate debt, and that helps them because if interest rates go up a lot, then they have to refinance the debt at the higher rate, especially companies like AT&T with a ton of debt. So generally, lower interest rates help companies. I mean, maybe it affects banks more because banks charge, they make money by loaning money out. So the higher the interest rate, the higher they can charge on those loans. But the higher the interest rates, the more they have to pay interest to get the funds to loan the money out. Large mega cap cash flow margin. Do you sell covered calls? I used to do covered calls until I got my Meta stock called away. Haven't done it since then. But that's a good way to start options, is do covered calls. It's a really safe way to learn about it. But if your stock goes way up, you don't benefit from that increase. It's only if the stock goes down or the stock stays pretty flat. That's when you could really benefit from covered calls. If the stock kind of doesn't move too much, then at least you could make money off the stock. So let's go back to this. So Agile Therapeutics. So they finally got a drug. With FDA, they finally got a drug in the market, which is a really hard thing to do. They're growing their revenue. 20 million is a lot, but it's 4 times more than their market cap. Yeah, those SPACs are killers. The problem is with certain stocks, if you do covered calls, you make like almost no money. Like the way it works, like say you own 100 shares of Goog 143. Is it 143? Say you own 100 shares of Google at 143. You can sell a covered call. So one contract equals 100 shares. So you could sell a covered call, but you have to pick a. Let me log into. I'm going to log into E-Trade, and then I'm going to show you. I'll show you exactly how it works. It's pretty easy, but it could sound confusing, which makes. Okay, here it is. Exposing. Okay, so I mean, if you want 100. So if you own 100 of this, you do, it's a decent amount of money. It's I hate seeing cents. It's so annoying. So if you own 100 shares of Goog, you have 14K of stock in a company. And the way it works is does anybody know about options? Do you want me to go through this? I did a video on options. So you want to pick an expiration date, and you could pick December 29th, but it's already what, the 24th? It's you want a little room for the option to move. You could go out a year or two. What are those called? Leaps? If it goes. So let's just go out. Let's go to February 16th. Give us 6 weeks of breathing room. February 16th. So let me. February 16th. Okay. So that's the first step. And then you got to pick a strike price. You see, we're doing calls. You could do puts. Maybe I'll explain that in another video. But we'll focus on calls because we already own 100 shares and we want to just make money on the stock. And I'll show you how you do that. The next thing, you pick a strike price. And remember, the strike price is the price it could get called away. So you don't want to pick, it's 143. So you don't want to risk it getting called away. Let's open it up a little bit to more. Okay, so let's do 170. Okay. The expiration. Okay, the strike is 170. Okay, strike is 170. It's trading at 143. And now the bid ask. So it's kind of like when you buy a stock is a bid ask price, right? And it's usually like within a penny or two, the bid ask, because it's so liquid. You're pretty much not going to, you can't really ask more money than the stock's worth. But options you could, because it's in a liquid market, there's not as much activity. So it's bid ask. Generally, you go between the bid ask, so which is 55 cents. I mean, you could ask. Obviously, you want to ask for the most because you want to receive the most money. So let's say you put in 55 cents, which is probably what you would get. And since it's 100 shares, so you get 55 bucks. If you'd have to put it out there in the market. If somebody says, I'm interested, I'm going to buy the options contract from you. So they would give you 55 bucks. And then you keep the money regardless of what happens. So now here's the part to kind of understand. So it's 143 today's price, and the strike is 170. So the only way they would call the shares from you is if the price was above 170. So February 16th. So if it never got above 170 between today and February 16th, then the option would expire worthless, and you would keep the $55. Now, say it hit 175, you would lose the shares. It would get called away. So you didn't benefit from that $5 increase in price. So you could have made $500 if you didn't sell the contract. But even if it goes to say it goes to 170 spot 5, it only goes up 50 cents. Then it would get called away as well, but you made more money because you made $55 from the sale of the option, and you would have only made 50 from the increase in stock price. But that's the thing with options, is it may not seem to benefit you. So that if you go closer to the money, this is in the money right here. In the money means it's already, you can already exercise the option. So let's say you did 150 instead, because you thought Google actually might go down. So let's say you sold it for 375, the option at 150. So you receive a $375 from the person who sold you, who bought the option contract from you. And then if the stock price never gets above 150, you just keep the 375, and it worked out. Even like if it goes down to 149, you lost $100, right? I mean, you didn't lose anything because you didn't sell the stock. But if like today you sold this contract for 150, and by say February 16th, the contract expires worthless because the stock never even hit 150, it hit 149. So you're down $100 on the stock, but you made that 375 from selling the options. So you're actually up 275. So it worked out that you sold this contract. That's why a lot of times you don't really make that much money. So it seems like the risk doesn't really benefit you unless you wanted to actually sell Google already. Like say you actually wanted to sell Google, you wanted to get rid of it. What you could do, and you thought Google was going to go down. So it's 143. Say you actually thought it would go down. So you're going to do the 130, which means they could buy it off you right away. But you would sell it, you get a pretty hefty premium. $15.60 is the premium you would charge them. So you get $1,560 from this person that buys the contract from you. But the strike is, what was it? 130. What am I doing? The strike is 130. So already they're in the money because 143 minus 130 is 13 times 100. So they're already in the money. They can just take that contract, take the shares from you, and make $1,300 if they sell it. But they wouldn't do that because they already put $1,560 into it. Now, if the Google goes down a lot, if it goes down to say 125, then you did well because you got $1,500 from selling it, and you still have your shares, so you could just sell your shares. Right, you can roll. Yeah, you can roll it. You can always roll your options forward also. I just don't see that much of a benefit usually because you don't get as much money if you sell. So if you don't like a stock, I'd say just sell it. covered calls, but there's also some benefits. You can buy put if you want to buy a stock, but you think it's trading too high. You can buy puts from someone, so you can collect the premium, and you could trade puts in the money puts. So you would receive the premium from the option contract, and you may be forced to buy Google at 120 at some point, which would be a lot lower than 142. Obviously, you'd only be forced to buy it if it went down below 120. So my friend used that strategy for Tesla. He sells puts, because even if Tesla doesn't go down like he thought it would, he's still going to make money. But you don't want to sell like uncovered calls, because if you don't own Google, right? That's the riskiest thing. If you don't own Google and you sell these option contracts, and say you did the same thing, it's trading at 143, you sold the contract at 160, you may be forced to give the person Google shares if it breaks through 160. You say you do 200 Google, you're like, oh, there's no way Google will hit 200. But if Google can theoretically go to infinity, so I mean, say it went up to 300, which is crazy, then you may be forced to give him $30,000. You buy Google on the open market for $30K. So you don't want to sell uncovered calls, because as long as you have the shares, you don't lose. The only thing you could lose is the shares. But if you don't own the shares, you can lose everything, because you have to buy the shares to give to them if they call you on it. That was why you receive this premium. See, it's kind of hard to explain, but it makes a lot of sense when you do it. But I'm not sure if I did a great job explaining it. I did make a video before about it. So I mean, if Agile revenue is going up pretty dramatically. And it's being sold in the open market. Let's see if they have more investor events and presentations. Let's look at this most recent presentation. I mean, there is definitely a risk they'll go bankrupt. I think that's why it's priced so low. Twirl delivers. So it's just a patch you put on your body, so you don't have to worry about getting pregnant. That's really their focus is Twirler. So their goal for 2023 is 25 million of revenue. They're already at 25 million is like 6.25 million a quarter, right? That's averaging 6.25 million. And they beat that this last quarter, 6.7 million. Before that, 5.5. Before that, it was around a little under 4 million. So all they need is 5 million in the fourth quarter to hit that target. So I'm pretty sure they're going to do that. They're going to hit that target. And then if they hit their revenue goal, maybe the stock will go up a lot. Announce expected generation of positive cash flow from operations. So they're expecting positive operational cash flow in 2024, which is really big for a company. That doesn't mean they're still not going to have enough money to pay back any debt they have. I'm not even sure. Do they have debt? There lies the rub. Assets of 11 million, liabilities of 23 million. So that's why they're pretty levered up. Well, only 2.5 million of debt. That's not too bad. What's the other liabilities? So you always try to convince yourself, if you want to invest in a stock, you convince yourself why it's a good investment. And if you don't want to invest in stock, you convince yourself why it's a bad investment. So I'm like trying to convince myself. Have you ever looked into BHC? No, So the problem is their liabilities. They have a lot more, like their current ratio is well below 1. So they need 7 million, I guess, in debt financing to cover this shortfall for the year, to get through the year. Because the accounts payable is 7 million. They have only 1.6 million of long-term debt. But that's due within 12 months. So they're going to need they could probably push off the accrued expenses and accounts payable another, few months. And they might be able to refinance the debt. Notes payable of 2 million. The company allocated proceeds of 20 million according to ASCII 470. The relative perceptive warrants. Risk-free interest rate. I'm looking for like the terms of the debt. Is Coinbase good investment to hold? I think Coinbase is a good investment to hold. If I was going to invest in a crypto, I would do Coinbase. Maria, she won twice, last week and a few months ago. So Maria can tell you, you get your $20 Amazon gift card. It's not a scam. But make sure you email me. This company was not a falling knife for several years. It was a falling atomic bomb. I think I'll pass. I know it seems so risky, but I guess it's easy for me to say because I didn't lose any money with the stock. What do you think of S&P 500 will get before there's significant pullback? Not just S&P, it'll go to infinity. I mean, it'll go up. Overall, it's going to go up because it's the entire U.S. market. I don't know, like next year exactly what it'll be, but it generally goes up over time. I think it's a pretty safe investment. I have a lot of my I have like 20% of my portfolio in S&P 500. So with options, the shorter the strike, the shorter the expiration date, the more premium you can get on your. What am I saying? The less premium you can get. So if it's $145 strike price, and if it only goes out to December 29th, you're not going to get much money out of that. You get like what? like 70 bucks. But if you go out to 2026, you get a hefty premium. You get 2,500 bucks from selling a call option because you're giving someone 2 years to take your Google stock. So over the next 2 years, will Google hit 150? I'm sure it will. That's why you're getting such a hefty premium. And if it's in the money, even heftier. So you get $4,000 from somebody if you sell this. Okay, anyways, yes, Spiders is a really good buy and hold investment. So positive cash flow. I think if this is true, and I think they will hit 25 million, and I think there might be a chance they have positive cash flow because these type of companies don't have, their expenses aren't too high relative to other companies. So I think there's a decent chance to have positive cash flow. And then if that happens, they can easily get debt financing or issue more stock. Companies that are successful have a much easier time getting funding because it's kind of like if you have a business with $1 million of sales each year, the bank is more likely to give you a loan than say your friend who doesn't have a business or who loses money each year in his business. So the more successful the company is, the easier they can get debt in the open market or easier for them to issue more stock. So, I mean, I wouldn't be shocked if I invested and lost 100% of my money. And I wouldn't be shocked if I invested and I 20x my money. It's really a risky investment. It's not a slam dunk. It's not like you're investing in like a Google or a Apple. You know, those companies pretty safe. I'm not sure what they'll do in a year or two, but in a 10-year period, I don't think there's much risk. Why not buy Berkshire shares? They seem to cherry pick the best companies. No, that's what I do. I mean, I do own one share of Berkshire Hathaway. Premium collector. What's up? Thank you. That's really nice. Things to look. Really appreciate the donation. That's really nice of you. I think it's fun gambling, and I can turn $1,000 to $50,000 on a Berkshire Hathaway. I could turn 1,000 into 2,000 if you give me 5 to 10 years. But I think it's fun trying to find these. And I don't know. I mean, but you learn a lot. You learn a lot by doing stuff like this. If you just keep talking about things and never put your money there. I use SoFi for savings, checking, and investment platforms. Stock is favorable. Up. Nice. Yeah, SoFi, it's a good company. Like that's what I'm saying. This company, it's risky. They only sell one product. And I think the one product they sell, I think it's an important product, but it's not like this product that everybody can buy. You have to be a woman. You have to be a woman in a certain age group, and you have to be a woman in a certain age group that does not want to get pregnant, and that's, I guess, somewhat sexually active. So, but when you invest in a company like SoFi, everybody needs banking. Everybody needs loans. And they're fintech, so they have a much larger population. And many customers, and they're somewhat of a proven entity. So it's risk versus reward. That's why you can make so much money on a lotto ticket, because the risk is so tiny, a few bucks. But if you magically hit the right numbers, you can turn that $2 into 2 million or 20 million. But this is much safer than a lotto ticket. It's like a 1 in 1,000 chance of hitting, as opposed to 1 in 300 million. I don't know. So what did everybody think? I'll grab a small bag of this pregnancy protector company, but don't buy unless you expect it to go to zero, or unless not expect it, but unless you can handle it, because everybody's lost money on this stock except the people that work at the company. They're doing really well, but like twirl of demand momentum, business plan is performing. So retail cycles, non-retail cycles. Cycles. Does that mean the women's reproductive cycles? So they were only retail, 2,500. And so they finally started selling in 1Q 2021. It tripled, and then they added some non-retail. So I guess they sell in retail stores like Walgreens, and non-retail, that means it's getting prescribed by the doctor. I could look at their. So okay, then it grew very little in that quarter. 30% growth, another 30% growth, 20%, about 30%, 20% growth. So they are growing quarter over quarter. It seems like it could be the time to get in. Consecutive quarters of factory sales growth and managed non-GAAP OPEX. Factory sales. So the sales, you see the green line is going up, which is great. Operating expenses is going down because before you actually, the product, like while you're developing a product like this, you have to spend a ton of money in testing, and then you got all these like fees with the FDA, because the FDA you have to do, there's like phase 1, phase 2, phase 3. There's pre-phase clinical trials, and each phase you have to test it with like maybe 100 people, and then show the FDA the results of that test. And then you have to test it on different like amounts of the product. So maybe one patch would have less of a certain ingredient or more of a certain ingredient. And then you have to test age groups, a lot of testing, because it's not easy to get FDA approval. If it was easy, then people would be at risk, right? If you can just put a drug out there and people buy it and then they die, that's not good. Or they get really bad side effects and they have problems for the rest of their life. So it's really hard to get FDA approval. So you spend an enormous amount of money, sometimes billions, until you get, and it could take literally a decade to get. But FDA approval is like an amazing thing, because that means the U.S. government is pretty much, or the U.S. is saying you are allowed to sell this drug to the public. Kyle, thank you. Happy New Year. Kyle, I think he's the most generous person on the stream. Kyle, somebody donated $50 earlier, and I think you're the only one who ever donated that much. I think you might have donated more actually once, 100, but I really appreciate it. So as they are done with all the testing and all this work to get FDA approval, their expenses are actually going down. Eventually, the expenses will start going up because maybe you have to hire more employees and you have to do all these extra things. But that's a good sign, seeing their operating expenses go down. Closing the gap between quarterly net revenue and non-GAAP operating expenses. So this is a similar. So net revenue is revenue minus like any discounts you offer, or returns if people don't like the product. But most companies don't report net. They report net revenue. You don't see the gross revenue. You just see after all the discounts. With volatile and binary event moving biotech sector, I tend to look for multiple drug pipelines. Yeah, that's the thing. That's another thing, premium collector. You want a company that has a lot of drugs, not just one. But a lot of there's companies that have many drugs in the pipeline, but nothing FDA approved. But it's an acquisition target, I think. I think it could be an acquisition target. So that looks good. What's the blue line? Oh, net revenue. Operating expenses are coming down. Net revenue. Look at that. They got gross profit. That's good. Because they have to make the drug too. I think I have to just buy some just to track it, but I'm not sure if I'll buy that much. They're focusing its Twirler promotional efforts on 5 states that have high levels of reimbursement potential for Twirler, and are estimated to reach over 45% of women between the ages of 18 and 24. This targeted geographical strategy ensures maximum. So it looks like they're focusing the 5 states: Illinois, New York, Florida, California, Texas. Yeah, that makes sense to me. I mean, I'm not sure about Illinois, why, but the other states I could see, those are pretty highly populated states. But I guess they identified Illinois as retail channel growth. Distribution is so important. Just because you have a drug in place, you need that distribution. You need to sell it somewhere. You need retail stores to carry it. You need, if retail stores don't want to carry it, then you have to sell online or sell on your own. So it's a lot of, and eventually the more popular you become, then larger, like a Walgreens. If you're popular, Walgreens will carry your stuff, or those larger chains, CVS. Bots is a good ETF. So it seems like the risk return is pretty good, but I don't know. Because, I don't think it's going to, it's so small. That's why it has a chance to like 50x or 100x. Because even if it goes up, don't look at the stock price, $2. Look at the market cap. Stock price is kind of meaningless. If this goes up 50x, that goes from 5 million to 250 million. It's still a tiny company, 250 million. And a company with 20 million of annual revenue, $250 million market cap is not crazy. You won't see like a $2 billion company, 50x is 100 billion. That's a big disparity. That's 100 billion is like you're one of the top 100 companies in the U.S. But that's why I see it's possible. But I don't know. What does everybody think? Oh, yeah, I wanted to look at their Let me do another raffle. Make sure you email me if you win. 7. 7. Did I miss anyone? Lander 484. Maria. $207. And the more people that watch the videos and stuff, it helps me do these things. it helps me do these types of raffles, or at least it motivates me to do the raffles. Okay, see ya, 207. Thanks for joining. 16. 1. 6. 16. Okay, that's it, right? Michael Starks. So these are 2 winners, $20 Amazon gift card. I'll email it to you. Make sure you email me. This is my email right here. Okay, we did look at their this is how you can identify of a company historically how they've been doing, because the balance sheet is at a point in time. As of 9/30, they have 2.9 million of cash. Oh no, 3.5 million of cash. 5 minutes. Okay. But you don't know historically how much cash they had. But the equity section, historically, they've raised $406 million from selling stock. And historically, they lost $418 million from running their business. So that's why they have negative equity. They use all the money, all that $400 million, they use it to develop the drug. You know, a lot of that was payroll for them and all the fees and things like that. So they're going to need more money to get through 2024. But 2024 may be the year they break out. AGR looks like a head and shoulders bottom, and on longer term, it could play out to a 3, 4, 3, 6. Take it with a grain of salt. Yeah, I think let's look at a chart. Let's look at the 1-year chart. That's not good. Okay, so here it is. So 1 year ago, 6 months ago, it was over $3 6 months ago. And then it did bottom out in September to $1.70. So that was about its lowest point ever, $1.70. It shoots way up because when a stock gets low, it tends to be purchased. The lower the stock price, the more attractive it is. The higher the stock price, the less attractive it is. And then it runs up, and then it comes back down. Then there's ups and downs, ups and downs, ups and downs. And now, is it at a point where it's going to go up again, or will it come back down to like this 170 mark? And is it worth it to hold it longer than a few months? Like, does it make sense? I don't know. It's interesting. I should learn more about the CEO. Like, what does he do? Oh yeah, Al Tamari. Well, we'll have to go have dinner. But yeah, thanks for joining. And thanks for the donations. Really appreciate it. Happy New Year to everybody. Happy holidays. And leave comments. Let me know what videos you want. And I'll see you guys soon. Okay. See you, Jan K.